Welcome to DCAKings, where we make long-term wealth building simple. All our concepts are backed by historic charts and data. Unlike much of the investing info out there that's complicated, behind paywalls, or full of scams, here everything is for free, transparent, and easy enough for anyone to follow. This here is the only investing video you ever need to watch. But if you want to dig a little bit deeper, check out the other videos in our investing playlist. Today we're going to cover why you need to invest, why long-term investing is actually less risky than holding cash. 2. The foundational knowledge what to buy, why broad market ETFs are the perfect safety net. And 3. How to buy, how to build a trade plan, choose the right account and broker type, and place your first order. Follow this simple guide and you'll outperform most investors. Have you guys ever noticed how everything keeps getting more expensive? When my grandpa was a kid, he could buy a burger for 25 cents. Today, that same burger costs $5. The burger didn't get 20 times better. The dollar just got 20 times weaker. This is not a bug in the system. It's a feature in modern economics, and it's called inflation. Let me explain you really simple how inflation works. You go to the dollar store with $1 to buy a candy bar. Then the government comes along and prints more money. Now more dollars are in circulation, but the amount of goods in the economy, or in our example, candy bars at the dollar store, hasn't changed. To cover costs and maintain profits, the dollar store now has to raise prices. You come back a year later and the same candy bar is now going to cost $1.25. Governments do this to stimulate the economy. In theory, wages rise, spending is incentivized, the government controls downturns, and everybody's happy. But in reality, inflation is just a scam on the poor. It just makes the rich richer. Why? Because the rich don't hold cash. They own assets. Companies, real estate, stocks, things that go up in value while money loses value. Meanwhile, companies pay employees the minimum possible, so wages rarely keep up unless somebody forces them to. You guys need proof of this? Decades ago, people in their mid-20s could buy a home. Now the average first-time home buyer is almost 40 years old. On screen here on the right, you can see the sharp decline in housing affordability. On the left, real median household income in the US is sitting around $83,000. But if income had kept up with housing prices, we should be sitting closer to $150,000 now. And if economic growth had been shared equally, the household income in the USA at the moment should actually be at $190K. In a fair and balanced economy, those numbers would make sense. But today, we're not even halfway there. Here's some more data. On screen, you can see the wealth distribution of the USA. The top 10% own about 95% of all wealth, while the bottom half holds less than 5%. The same pattern appears in the stock market. Most shares are owned by a few wealthy. Think about this. Over the last 30 years, nearly all gains from innovation and productivity, everything we as a society built together, have gone pretty much to those top 10%. If you want to grow your wealth, you have to play by the same rules as they do. It's simple. Follow the steps in this video, or you don't. The economy and the stock market will keep growing, just without you. So here's the truth. Remember this here. Investing is always defense. It's always riskier not to invest. As long as governments keep printing money, dollars, euros, Swiss francs, they all lose value over time. On screen here, you guys can see the decline of purchasing power of those three major currencies. Some fall fast, some fall slower, but the direction is always down. Any money you don't need for the next 10 years belongs in real assets. Investing in assets that capture economic growth is the best way to protect and grow your wealth. Even when the economy dips, the long-term trend always favors assets over cash. To make this even clearer, here on the right we have the global stock market, VT, reflecting global economic growth. On the left, you see the purchasing power, fiat currencies eroded over the last 20 years. All of them buy less over time. Even the Swiss franc, one of the world's most stable currencies, loses substantial value compared to the gains of the global stock market. The global stock market gains on average about 8% a year. Even adjusted for inflation, it's still around 5%. So remember, market up, fiat down. Let's get into the foundational knowledge of what to buy. I'm going to simplify things. A stock is a piece of a company, like Apple or Google. You buy it, you own part of it. If they make money, you make money. An ETF is a basket of hundreds or thousands of stocks. With an ETF, you mirror the growth of all the companies in the basket, depending on the weight. If one company crashes, it barely matters. The others carry the load. But on the other hand, if one of the company's stocks go parabolic, it also won't affect the overall ETF performance as much. That's instant diversification without having to pick individual stocks. Every beginner should start with a broad market ETF. Even experienced investors should keep one as a safety net. It helps with the psychological side of holding riskier assets. Check out our other videos on those topics. Every stock or ETF has a ticker symbol, which is a unique identifier. Two of the best broad market ETFs to consider is VT. This one tracks the global economy. If the world economy grows, VT grows. And then we have the classic VOO. This one here tracks the US economy. If the US economy grows, VOO grows. Once you've secured a broad market ETF as a safety net and are comfortable with some volatility, you can add riskier assets. Some of my favorite are QQQ. This is an ETF that tracks top tech companies. Or IBIT. This ETF gives you Bitcoin exposure. You can also add individual stocks. But remember, when picking ETFs, do your research. Even professional advisors often give really bad recommendations. If the 5-year returns are below that of VT, it's most likely a bad investment. On screen here, you can see the list of our top 10 ETFs. Keep it simple. You shouldn't need more than 4. For maximum gains, less is often more. Lots of people fail at investing, not because of bad picks, but because of bad psychology. They panic sell when the market crashes, and they FOMO back in when the market pumps. That's how you lose. The market goes through extreme fear and greed cycles that even shakes out professionals. So you need a trade plan. First, you're going to decide what you're going to buy, why you're buying it, and when. Maybe just VT, maybe a split of VT and QQQ. Then you decide when and how often to invest. If you have a lump sum and you can handle volatility, you can invest everything at once. But most people with fixed income use a DCA dollar cost averaging strategy, which basically just means they invest a fixed amount regularly, no matter what the market does. Remember this here, timing the market is almost impossible. In the short term, nobody knows if it will crash, how deep a pullback might be, or even if it just keeps pumping. Even with the possible current AI bubble, back in 1996, before the dot-com bubble burst, lots of analysts already knew it was a bubble. On December 5th, 1996, Alan Greenspan, a famous financial analyst, gave a public speech in front of the Fed, and he warned about the dot-com bubble. Today, we all know it was a bubble, but here's the crazy part. Anyone who invested in a broad market ETF or early QQQ equivalents before that speech never saw any real drawdown. Fast forward to 2008, the market did come down and touch the same level from Greenspan's speech, and maybe went 2% below that, and then it bounced. So the crash never erased any of those gains from before his speech. So keep that in mind. We could be in a really similar situation today, and that speech maybe didn't even happen yet. Maybe if you buy today, you're also never going to see any real drawdown. Nobody knows. So this is the takeaway. Waiting for a crash to buy is almost always the wrong move. Always invest, and if a pullback or a crash happens, you just try to buy more. And I hope I don't need to say this. Don't try to short the market. If you short the market, you're basically betting against human progress. Even hedge funds, which specialize in timing the market, rarely beat broad market ETFs over decades. So ask yourself, honestly, do you really think you're smarter than them? Finally, you decide in advance when and under what circumstances you plan on selling. For example, maybe in 2045, you start selling 10% a year and you put that into a high yield savings account. Investing means holding for at least 10 years. If you want to make money selling assets, you need a plan to hold them for at least 10 years. This goes for most high quality stocks like Google, ETFs like VT, and even Bitcoin or real estate. Here on screen are some simple portfolio examples with trade plan. Starting with 100% VT is essentially just betting on global economic growth. Any beginner with income should have exposure at this level. Then you can maybe also add some QQQ. This is going to give you some tech growth exposure. And then even more, you could include IBIT, a Bitcoin ETF, which creates a portfolio with high risk but extreme upside potential. But be aware, these high risk portfolios can easily drop 80 to 90% in value within weeks. You need to be honest with yourself. If you saw your investment lose 90% of its value, would you hold through that fear cycle, or would you panic sell? Because it's better to stick with VT than chase riskier assets if you'll end up capitulating to volatility. When investing in a broad market ETF like VT, you don't need to do much research. Just be aware that the markets are volatile. You may see your portfolio lose 40% of value in a year. Over time, it will recover, and you only lose if you sell early. When adding riskier assets like QQQ, BTC, or individual stocks, be sure to do your research and understand the risks. Let me show you how to set up and buy your first ETF. First, you need to open a brokerage account. There are lots of options out there, some good, some not so good. In the US, Fidelity is very beginner friendly, and for worldwide use, I recommend Interactive Brokers, which professionals love. The interface is slightly more complex, but still manageable for a new investor. If your country has tax-advantaged accounts, be sure to max them out. Check out the list on the screen with different accounts in different countries. In the US, this means a Roth IRA. Your money grows tax-free and can be withdrawn tax-free later if you follow the rules. Basically, you're not going to be taxed on your gains, which you are in a taxable account. This is one of the only legal cheat codes that they give the working class. Only 1 in 5 Americans opens a Roth IRA in their lifetime, and only 1 in 10 has a solid investment strategy. So now, let's walk through how to buy your first ETF. First, you need to open the brokerage account either through a browser or a phone app. You link your bank account and you transfer funds. Make sure to max out your tax advantage accounts first. On screen, you guys can now see my Roth IRA on Fidelity on the left and my taxable account on Interactive Brokers on the right. Then we search for the ETF ticker. On Fidelity, we'll be buying VT. And on our Interactive Brokers account, we'll be buying QQQM. This is the same as QQQ, just at a smaller share price. I'm going to set market order, enter the dollar amount or number of shares I want to buy, and hit buy. That's it. You should get a confirmation that your order has been filled, or you can also see your transaction history. Congratulations, you just joined the 10% club. So ladies and gentlemen, I really hope you guys understand these key takeaways here. Cash always loses value. Own assets that rise with the economy. Start simple. 1 or 2 ETFs is enough. Stick to your plan. Buy a lump sum or DCA. Hold minimum for 10 years and ignore the noise. The biggest risk is not a market crash. It's doing nothing and letting inflation eat your savings year after year. Start now. Even small amounts grow massively over time. Time in the market beats timing the market every single time. You can find all the concepts we covered today in our DCAKings ETF cheat sheet. It's linked in the description. Check out our other videos where we cover topics like picking stocks, safely buying and owning BTC. Drop questions below. I'm happy to help. Give this video a like and a subscribe to help us get the message out there that investing is not hard. You just need to start.